Every startup needs a finance team. Almost none of them have one, so founders improvise. Not because they are careless, but because a real finance function costs more than an early company has. And founders are strapped for cash at exactly the point where the decisions start getting expensive. We wanted to bet on them early and grow with them. That meant the work itself had to become efficient enough to carry, because discounting it would only have moved the problem somewhere else. What follows is how our practice is built and why. Nothing here is being sold. The system you will see partway through is simply the one we run on ourselves. Improvising has a shape, and it is worth being precise about it because the failure is structural rather than careless. A finance function is 4 separate jobs, and no early company can staff all 4. So it starts as do-it-yourself, a founder and a spreadsheet, then a bookkeeper, then a CPA at tax time, then a fractional CFO before the raise, each one arriving in response to something that has already gone wrong. Doing finance yourself is rarely wrong in a way you notice at the time. It is wrong in 2 quieter ways. The first is money left on the table. Tax overpaid because nobody structured it. An election missed because nobody was watching the date. A credit never claimed because nobody knew to look. None of that shows up as an error. It shows up as nothing at all. The second is mistakes found late. A misclassification sits harmlessly for 2 years and then surfaces in diligence, where fixing it costs a multiple of what getting it right would have, and where the finding itself becomes a negotiating point. And there is a third cost that almost nobody names. The founder ends up explaining their own company 3 separate times, and then carrying the job of keeping all 3 teams consistent with each other. Nobody ever offered them that job. When context slips between those teams, the failures are not cosmetic. A missed election, a misclassified expense, a filing everyone assumed somebody else owned. Any one of them costs more than a year of doing this properly. That is the real price of the seams. So the problem is not the people. It is the shape. 3 teams doing 4 jobs on the same company, none of them able to see the other's work, and the only connector between them is a spreadsheet the founder maintains. Replace that connector with 1 shared context per client per month that every discipline writes to and reads from. Bookkeeping writes it. Accounting closes it. Tax reads it. The CFO explains it. Everything else follows from that one move. It is the simplest idea here and the hardest to actually do. Knowing the fix is not the same as being able to afford it, and that is where most firms land. The obvious answer is to discount the same work, cut the fee and hope volume covers it, or quietly assign a junior and less attention. Both are real, both are common, and plenty of good firms are doing exactly this. Neither holds up around the 10th client, because every client still takes the same effort to learn. We went the other way, and changed how efficiently the work runs rather than what we charge for it. Put every discipline on 1 shared context. Write handoffs down instead of holding meetings. Let AI draft and an expert sign off, which makes us not the budget option, but the practice that can carry an early client without cutting corners. Learn a client once, then never again. Making the work efficient to run meant building something, so we did. We built Clarify for our own practice. Not to sell it, so that a pre-seed founder could have a real finance team and we could still run a business. We would have been perfectly happy to buy it instead, but nothing on the market put the 4 disciplines on the same context. 1 detail sounds like a technical footnote and is actually the whole reason the rest of this works. It was multi-tenant from the first commit. A practice is a book of clients, and every client needs its own isolated context, so tenancy was never something bolted on later. Before any of the technology matters, there is something underneath it we will not trade. In financial advisory, the relationship is the asset. A founder hands over the books, the payroll and the cap table, and trusts us to be careful with them, and to know which numbers actually matter. The software can be duplicated. Trust cannot. Nothing we could do to go faster is worth spending that. So a number carries our name, which means an expert checks it before it leaves. What a client tells us stays with the team serving them. Every tenant is isolated, including from our own practice. Client data is never shared with third parties and never used to train public AI models. Encrypted in transit and at rest, US-based storage, role-based access, a full audit log. That is the floor, not the achievement, and all of it arrives on day one. Which gives us the operating rule. Slow where it matters, which is judgment, tax positions, and anything a client is going to act on. Fast where it does not, which is reconciling, categorizing, chasing documents, and formatting. Nobody's relationship with their accountant was ever built on how quickly a bank statement got categorized. With that settled, here is what the stack actually consists of. And the first thing to say is that clients move off nothing. They keep QuickBooks or Xero or Zoho, plus the sheet where their operating metrics already live. We connect. We do not replace. Around that sit the feeds that show where the money actually went. Bank accounts and credit cards. Ramp because department-tagged card detail is how research, sales, and general expense splits become real numbers instead of a guess off a P&L line. Gusto because payroll is the biggest line on most early P&Ls, so runway and burn are only ever as good as the payroll data underneath them. And Carta for the cap table, the grants, and the 409A. All of it lands in one context per client, per month, holding more than 50 metrics, with bookkeeping, accounting, tax, and the CFO writing to it and reading from it. Underneath, the arithmetic is deterministic, tested code. Never a language model. Out the other side, our team works from it, and so does the founder through their portal, their board pack, and their own AI assistant. Every number a client sees comes out of this, and there is no second version, because we stopped keeping our own copy of the truth somewhere else. That line about never a language model deserves unpacking, because it is where most of the engineering went. A language model predicts the most likely next token. It is exactly as confident when it is wrong as when it is right, so a hallucinated number is indistinguishable from a real one at the point where you read it. In most software, that is survivable. In a filing, it is not. A ledger requires the opposite. Same inputs, same answer every time. Every figure traces to the entry behind it. Unit tested to an exact value. And both of those end on the same sentence, read two different ways. 99% right is a good score for a model. 99% right is a restatement for a ledger. So AI drafts and an expert signs off. Behind that sit 4 things we refuse to do. Let AI produce a number. Let a draft go out unread. Publish a figure with no source behind it. Or offer speed we could not defend to a client. Tested code does the arithmetic. AI drafts the explanation. Every automated output lands as a draft with its source. And nothing reaches a client without an expert sign-off, where expert means a qualified accountant, a CPA, or a CFO. It is enforced in the code, rather than in a policy somebody has to remember. Within those limits, there is a great deal AI can usefully do, and it is not the kind most people have met. A chatbot waits to be prompted, which means it only ever helps the person who already knew what to ask. Agents work on their own schedule, across every client in the book, and stage a draft before anyone thinks to look. The work does not wait on a human remembering, and that is exactly where a small team loses its month. They draft the close, assembling the month's package and flagging what moved. They categorize the books, proposing account mappings from our own precedent. They watch the cash, with runway thresholds and burn spikes, across every client. They track every agreed metric, every month, and flag it when one moves. They stay on top of estimated tax, franchise tax, and filings, so nothing arrives as a surprise. And they write the first draft of commentary and variance notes for a CFO to edit. All of it repeatable. None of it judgment. Everyone lands as a draft, and an expert still decides. When one of them gets something wrong, it gets caught in review, which is exactly why the review is not optional. The same discipline shapes how the team is arranged, across 2 offices and 1 clock. The back office is in India, an experienced, US-credentialed team handling bookkeeping and accounting. That is the reconciliation and close engine. The front office is in the United States. Certified public accountants and the CFO, client-facing, carrying judgment and the relationship. Remote by default on purpose, because the shared context is the office. This is not a cost arbitrage story. It is the constraint that forced the discipline. A team that shares a room can survive sloppy handoffs by shouting across it. We never had that option, so every handoff had to be written down. Overnight in India, the sync lands, reconciliation runs, and anything unclear gets logged on the shared context, rather than emailed to somebody who is asleep. The next morning Pacific, the front office opens one shared view and sees where the close stands and what needs a decision. No status call. And the same day, the client hears back. Half a day apart, and nothing gets re-explained, which most teams sitting in one office cannot say. US credentialed on both sides of the clock, so the expert who signs off is an expert wherever they sit. Seen from the founder's side, that clock becomes a month with a shape to it. And the thing worth saying first is that a founder does not trust a platform. They trust the expert who answers. Those experts are reachable by name, on named threads, and it is the same 3 every month. The accountant who knows the ledger. The CPA who signs the positions. The CFO who answers the questions that matter. Not a support queue, and not whoever happens to be free. In the first 5 days, bookkeeping reconciles bank and cards, the close opens, and tax alerts are already queued. Through the middle of the month, categorization and aging tie out, accruals and revenue recognition go in, estimates get reviewed, and the CFO's draft package is assembled. By day 20, statements are drafted, positions documented, commentary and variances written. After that, the period locks, filings are tracked, and the package goes out on a second review. The founder's row is 3 items long. Upload what did not sync. Answer 1 thread. Read the pack. That is the entire ask we make of a client, against 4 separate relationships and 4 separate inboxes. What is absent matters more. No status meeting. No chase. Nobody asking where we are. Nothing is relearned month to month, and that compounds. Same team, more startups. Context accrues with the client rather than in a person's inbox, which also means someone leaving stops being a data loss event. That is how the work runs. What a client actually gets out of it is a different question. Statements tell a founder what already happened, and nobody ever changed a decision with a number that old. What most startups get is the monthly rearview mirror, a P&L 6 weeks after the month ended. That is not incompetence. It is what a competent bookkeeper delivers. It is just insufficient, because it cannot change a hiring decision that was made in week 2. The useful numbers lead. Runway with a date on it. Pipeline before it becomes revenue. Usage before it becomes churn. And half of them never touch the ledger. Which numbers lead depends entirely on what the business is, because a marketplace and a clinic do not have the same early warnings. For a SaaS company, it is monthly recurring revenue, net revenue retention, churn, and CAC payback, because retention moves months before revenue does. For a marketplace, GMV, take rate, liquidity, and repeat rate, and the point there is watching supply and demand separately. For an AI or usage-based company, gross margin, cost per call, and usage per account, because inference cost is what decides whether growth is worth having. In fintech, unit economics move with rates rather than volume. In healthcare, it is days in accounts receivable and payer mix, because collection speed is the real constraint. And for services and agencies, utilization, realization, and backlog, because sold work is not the same as delivered work. The set is agreed with the founder during onboarding, then tracked every month, and the exchange runs through a shared Google Sheet. Signups, usage, pipeline, and headcount are not in the books, so the founder drops the operating numbers where they already keep them. It syncs both ways on a schedule, and nobody logs into our system to report their own business back to us. One agreed set of definitions, the same every month, is what makes a trend mean anything. Those same operating numbers feed the models, and founders hear the words financial model and picture one enormous spreadsheet that one person understands and nobody trusts. It is a set, not a model, and each one is pointed at decisions somebody actually has to make this quarter. Runway and scenarios: base, optimistic, pessimistic, and the date the cash runs out. Hiring impact: what the next hire does to burn and how long it takes to pay back. Pricing and usage: what a change to price or packaging does to margin. Break even and return on investment. What has to be true for a bet to be worth making? Budget against pro forma, the plan and what actually happened against it. And dilution and use of funds. What around costs and ownership and where the money goes. Every one of them computes in tested code, from the books and the operating KPIs together. So the hiring model sees actual usage and pipeline, not just last month's P&L. Not a spreadsheet somebody rebuilt from exports, and not a model that quietly disagrees with the financials. And because all of it lives in one context, a founder can simply ask it questions. We run an MCP server with more than 30 tools over the client context. A founder points Claude or any AI assistant at it and talks to their own numbers in plain English. What is my runway? Can we afford this hire? Backward and forward. Not just the statements, but runway, the agreed metrics, the pipeline, and the forecast. And those numbers are the ones their finance team maintains. Not scraped from a bank feed. Not self-reported into a chatbot. Not a model guessing from general knowledge. Reconciled data, agreed metrics, and reviewed reports, with an expert standing behind each one. Our own team works the whole book over that same surface, switching between clients without widening anyone's access. The guardrail is what makes it safe to offer. Read only by construction, scoped by token, revocable. It can read the numbers. It cannot move them. Most AI finance tools have no expert layer underneath to be right about. Every answer here comes from reconciled, numbers an expert already reviewed. All of which would be easy to claim and hard to check, so here is the check. Every claim in this deck is something StartupCFO.AI depends on to close its own clients' books this month. Nothing here is a roadmap, and nothing is a pilot. The month described on these slides is the one our team actually runs. What our CFO team edits and signs is what was described here. 2 days to onboard, connected, backfilled, first close open is our own standard. We are the first tenant, and the one with the most to lose, which is a very different position from a vendor demonstrating a product they do not personally depend on. Every failure mode gets found on our own book before any other firms. Clean books, and on-time close, and filings that never surprise anyone are table stakes. These are the outcomes. The first is the purpose of financial advisory itself. Decisions made on numbers rather than guesswork. Pricing, unit economics, the next hire, the raise, all argued from data instead of instinct. Nobody ever built a great company because their close landed on the 15th. The close matters because of the outcomes it makes possible. The next two are the ones founders feel fastest. The hours come back, and it is worth being specific about where they go. Not into building in the abstract, but into what makes the product different, which is the only reason anyone chooses you. And into serving customers, selling, onboarding, keeping them. Those two activities decide whether a startup works, and finance quietly competes with both. The fourth is that finance comes off the founder's desk and becomes a confidential, independent perspective to think with. A founder's scarcest asset is attention. Finance should not be where it goes. That last one is easy to say and worth slowing down on, because it is the thing founders feel most alone in. Who else is in the room when a hard decision is on the table? Not a co-founder. They have their own stake in every answer, so the conversation is already a negotiation. Not an employee. They report to the person doing the asking, so the honest answer has a cost. Not an investor. They sit on the other side of the table, so caution creeps into everything shared. None of that is about character. It is what the seat does to the conversation. What is left is someone qualified, outside the company, bound to confidentiality, with no position in the outcome. That seat is the part of the service no software provides, and it is why this whole argument kept coming back to experts. Pricing, the next hire, the raise. Exactly the decisions a founder cannot argue out with anyone who has a stake in them. Most founders have nobody in that seat. One last thought, and it is a hunch rather than an offer. We eat our own dog food. We solved this for ourselves using AI on something multi-tenant by default, and that is probably why the question keeps coming up. We have not tested it anywhere else, so we will not claim more than that the shape rhymes. A book of clients, A spread-out team and context lost at every handoff describes a law firm about as well as it describes us. Matters instead of closes. Or a wealth advisory practice. Households instead of companies, and the same question about who holds the context and whether everyone can see it. All of them are trust businesses. Someone hands over something sensitive, and the relationship is the asset. We have not solved it for them. We only say the problem rhymes. Which brings it back to where it started. Born of necessity. Kept because it works. One context. One team. Better decisions. We wanted to bet on founders at the stage most finance teams will not touch. And this is what it took to be able to. Thank you.